To this week's edition of The Accomplished Woman with Cathy Mendell, the show for accomplished women who are serious about their retirement. I'm your host, Kristin Oakley, and it is my joy to be back in the studio with Cathy Mendell herself. She is the president and founder of Theia Financial. Cathy, friend, it's great to see you.
It's always so much fun to be here with you.
I know, thank you. We have the best time.
We do.
I know you've thought long and hard about today's episode and put a lot of time and effort into a very important subject. You're going to want to hang on to every word. We're getting ready for a ride, I feel like, right? Yeah. Buckle up.
Right. Oh, good.
But we're going to be talking about risky business, this whole concept of timing the stock market. And Cathy, I don't know about you, but you and I have been in this industry combined for a very long time. And this whole concept of trying to time the market, it's something that a lot of folks try to do. And so we've all heard about this concept, and I think even in average layman's terms, we've heard, oh, stock market, right? You want to buy low, you want to sell high. The other way around, you want to, right? Yeah. Buy low, sell high. Yeah, not the other way around. So timing the market, unpack that. What does that actually mean?
A lot of that is driven by the media frenzy around the market. If you listen to CNBC or any of the news, you've got two people talking, they're all excited, they're almost shouting at you. You just feel like you need to do something, right? It's this hyperactive, hyper-intensive approach to thinking about money. And honestly, I was actually I had conducted a seminar, and when we were done, this gentleman came up to me and he asked me, the market's at an all-time high, and is this the right time for me to sell everything and move to cash and try to hedge my bets? And I couldn't answer that question because it wasn't the right question.
Yes, you're right.
Right? Because timing the market, trying to beat the downturn and then know when to go back in before it goes back up and all of that, that's not the right question.
No,
especially if you're close to retirement. In fact, it isn't the right question at all anyway.
Yes, I would concur with you on that.
Yeah.
But a lot of folks, that's what they think is necessary in order to earn money in the stock market, right? And they want to play that game. But I know you and I have talked on the show before, we are not about people subjecting themselves unnecessarily to that kind of risk. And the reality is nobody knows what's going to happen. None of us have a crystal ball. We don't know. And by the time you see that the market's gone back up, it's too late if you've already pulled your money out, right?
Yeah. So the honest solution is that you need to have a plan when you go into the market that you can stick with.
Yes.
And that you can settle into and then get away from the noise. Because the noise is a distraction.
Yes.
It makes you second guess yourself. It makes you feel like you need to be adjusting things. It makes you feel like it's insecure. I mean, you feel insecure when you're looking at and listening to that, and then even other people giving you advice, and nobody ever tells you how much money they lost, but they will always tell you how much money they got.
Isn't that interesting, right?
Yes, right. Because there isn't any. If there was a way to predict the market, if there was this known plan of going into the market, coming out of the market as the market unfolded, do you think that we would even? I mean, who wouldn't do that? Every advisor would know how to do that.
Yes.
Every investor would know how to do that. It is not something that you can actually do. There really is not a crystal ball. There's no way to see what's coming down the road.
Well, and I've heard stats, if you look at different charts, that if you've even missed just the best 4 performing market days, for example, over a 10-year period, you would have missed all the gains. And no one knows when those days are going to be. Yeah,
I actually had a person that I was chatting with the other day. She said, we have he's 65 and she's 57. So there's a little bit of an age difference. And she said, he can retire and we don't know what to do. So we just moved everything to cash. Oh, yeah. And I thought to myself, I understand that. I really do, because they know that taking a hit right now would not be good.
Right.
But I said, how long have you been sitting in cash? And she said 2 years.
Wow.
And I thought, wow, that's a long time. Now, I will tell you, it just happened to be 2 tough years in the market. So, you know, it worked out in their favor, maybe, but they're missing out on the comeback.
On the upswing.
They are. They're missing out on the upswing. So the point is that if you're going to be invested in the market, and the purpose of that investment is that you save money, you leave it there, you let it grow through all cycles. If you will do it that way, and especially if you're thinking about, you know, maybe you're 35 years old and you're thinking, you know, I better get serious about this. Or maybe you just got your first job that actually offered you a 401k with a match, right? And so you're starting to look at that, and you begin to put money into that 401k every paycheck. Your job is to put money in.
Yes.
And to select an asset allocation that you can live with. Because if you're invested in the market, there will be volatility. Your account balances will go up and down. If you have a long time horizon, your only job is to put money in. And then on occasion, maybe once a year, take the time to take another look at how you're invested. That's where the whole lifestyle funds came from. Because people didn't, you know, in the past, the employer was responsible for your retirement.
Right, when there was defined benefit plans,
Everything was a defined benefit pension. Nobody managed their own money. If you had money, it was in the bank in a CD. And then they changed all of that, and it became the employee's responsibility to tackle something that very few people actually are expert at.
Well, and they don't tell you how to do it. And even if you call, I know I had this experience when I was in my young 20s, got my first workplace retirement plan. You call that company and say, how should I invest my money? They can't give you personalized, individualized advice. They can just give you information, but it may not be what's in your best interest in terms of how that money is allocated, right?
Well, exactly. And you are always going to be asked for the risk questionnaire. Are you conservative, moderate, or aggressive? Well, that's not a good questionnaire, truthfully, because you know, if I were to ask you what is conservative, everybody has their own definition.
Everyone defines that differently.
They do. And what most people think, well, I don't want to lose money, so I'm conservative, or I'm aggressive, so I'm okay with losing money, or I want to make the most money I can. I mean, it's all over the board. So if you're building towards retirement, the real question is, should I be looking for the maximum growth? And if I'm young, then it should be, you know, 70% in equities and maybe 30% in bonds. There should be a lot heavier weight on that, because you're looking for growth. And you have to understand that the values are going to go up and down.
Absolutely.
However, I will say this. Not too long ago, I was helping a gal get into her investments. She had not been working for this company for maybe 10 years. Her 401k was still there. And she is right near retirement. And her investments were 70% equities, 30% bonds. And when the market went down recently, as it did, she lost a tremendous amount of money.
I can imagine,
Well, there was no one there to advise her. No one was looking out for her to say, wait a minute, your time horizon has changed, and we need to make some adjustments here. So, you know, now she didn't even know she had lost the money when we pulled it up. I asked her what was in there. She gave me the number. When we pulled it up, it wasn't that number at all.
Wow.
So
it's never a fun surprise.
That is not a fun surprise. But my point is that asking, should I come out of the market and should I go back in? Wrong question.
Yes.
The right question is, how much time do I have? How much money am I saving? And, you know, what can I live with? With volatility? What's not going to make me panic? And you know, move out of the market and sit in cash.
For sure. Well, I know this is what you do day in and day out for women, is you meet with them and you help them figure out these important questions, making sure that they're asking the right questions, helping them find the answers to those questions, and something as simple as, how should you be allocated, right? I mean, you can actually help someone figure out how they should be invested. So if someone's watching right now and they're like, yes, Cathy, I want your help, what do they need to do?
Well, the fastest and easiest way to do this is just to give me a call. Now, what happens is when you call our office, one of our team members will take your call, they'll get your information, and they'll actually schedule us with a call together on Zoom. That gives us a chance to get acquainted, to learn about your financial story. You can ask questions about Theia Financial, and we'll have the opportunity to just visit and then begin this process of crafting out your own personal plan. Where are you at in your journey towards retirement? And I would absolutely be thrilled to have a chance to have a visit.
Cathy, thank you so much. To our viewers at home, we are going to take a quick commercial break, but that number to call to get your complimentary appointment to meet with Cathy is there on the bottom of your screen. We encourage you, call the number 866-724-4927. You're also welcome to take out your smartphone. Simply scan that QR code in the bottom right-hand corner of your screen. That will take you over to a landing page and ask you a few simple questions, and then a member of the team at Theia Financial will reach out to you to connect you with Cathy so that you can set up your own complimentary appointment that way as well. We have so much more to dive into on today's episode of The Accomplished Woman with Cathy Mendell right after this.
As your life unfolds, sometimes you don't see the future. You're in the moment, you're doing what you do in the moment, right? As an example, we have an orphanage in Kenya. Who would have ever dreamed we would do that? We didn't set out to do that. It happened. Worked for the 𝗴𝗏𝗺𝘀𝗏 Corporation world headquarters for about 20 years. And one day I thought, I don't want to do that anymore. I want to be inside of what's happening in families. I want to be in people's lives. I decided to open a financial firm that is not geographically constrained, that anyone can get involved with, that was really focused on women. Because I feel like women have a little different priority. They see money a little differently than a lot of men do. Very accomplished women, very capable. They've been managing money their whole life. They understand the need to save, and they have saved money, and they have put time in to make sure they have a future retirement that works. They know that they need to reach out, and they know they need to work with a company that really can help them move forward securely. And that's our passion. That's what we're doing.
Welcome back to The Accomplished Woman with Cathy Mendell. I'm your host, Kristin Oakley, and Cathy and I are talking today about this concept of market timing and why that is not the strategy that you want to employ with your hard-earned money. And Cathy, I know before the commercial break, you were sharing the recipe, if you will, towards success for accomplished women, and a lot of that has to do with making sure you're regularly putting money away. I know you mentioned putting money away on a scheduled basis.
Right.
So can you unpack that a little bit more?
Yes. So the key to accumulation, it's not waiting for a windfall. It's not waiting for a big month of commissions or selling a house or anything of that nature.
It's not a strategy of hope, right?
Right. What you have to do in order to actually truly accumulate resources that you'll be able to use when you retire is it's got to be a consistent deposit. You have to consistently deliver that money to your savings vehicle, whatever it is.
Right.
Now, the thing is that the reason that that's important is a concept called dollar cost averaging. When the markets are high, well, you're putting money in, you're getting fewer shares. When the markets are low, you're getting more shares for the same amount of money. And it's so important that you're buying at all levels.
Yes.
So you're not only, if you only put money in once a year, whatever the price is at that time is what you got.
Right.
But if you're putting money in monthly, you can do that through, like an automatic bill pay if you don't have a vehicle at work. But let me do some math here.
Okay.
Because I think it's really interesting. So let's say that you're 35 years old. You're looking at this and thinking, I probably ought to start saving for retirement.
Right?
You may have already started, but you may not have either.
The good news is it's never too late to get started,
It is
right?
not too late.
You always just want to start.
Yeah, so you're working for a company that has a 401k, and so you start with a 6% contribution, and your company has a 3% match, okay?
Yep.
That totals $6,300 a year going into your retirement account. If you do that for 30 years, you would be 65 when you stopped, okay? So $6,300 a year times 30 years at 6% growth. We're not even talking about, typical market growth. I'm being very conservative here.
Yes.
That equals $525,000.
It's amazing how it compounds,
It
right?
does,
Yep.
if you do it
Yeah.
consistently.
Exactly.
Now, what if you had a $70,000 a year job and you thought, you know what, I think I better bump that up. Or maybe you get a raise, and instead of spending that money, you actually allocate part of that to your retirement, to your future self. So you put in 10% contribution and you get a 3% match. That's $9,100 a year. And if you look at that times 30 years, that's $794,000.
What a difference.
That's incredible. Yeah. And you know what typically happens is when you're earlier in your career, your contributions will be smaller, right. But as you age, those percentages will go up. And that is exactly what needs to happen.
Yes.
Because if you're doing that on a regular basis, you will have money to retire with. Yeah. If you start late, then you have to save more on a monthly basis, which can be hard.
And you'll never be able to make up that time. I think that's the other important thing to understand, is that time is the biggest asset any of us have. And so the sooner you start, the less you'll have to put away and the more you're going to be able to save than someone who starts later in life.
Exactly. And you know, what I would say to our audience listening today is you need a plan that you've actually written down. You cannot do this based on emotion. You can't do this, oh, if I have the extra money.
Right.
If you see it in black and white, like I just explained it, okay, I'm going to put these deposits in every month,
yep.
and then you watch that work. Oh my gosh, it becomes like it's exciting to watch those balances begin to increase.
Yes.
It feels solid. It feels like you are a solid person taking care of yourself and taking care of your family, you know, if you're married. So I guess my point is that your job is to save.
Yes.
Yeah.
It's to pay yourself first.
It's you have to do that.
The goal. Yeah.
I know. We all have heard it, but it's easy to let it scoot by. You're here, you're there, and the next thing you know, you're feeling under the gun and hopeless that you're ever going to get caught up.
For sure.
Yeah.
Well, I know, we've been talking about workplace retirement plans and how a lot of times companies do offer you something like a 401k, a 403b, the company match. But we know that there is a lot of accomplished women out there who are self-employed. Kathy, you and I have both been through stints in our career where we have not been working for somebody else. And then, so talk about that. What options are available to entrepreneurs, self-employed women who want to be paying themselves first?
Absolutely. So I'll tell you, your best friend is auto pay at your bank. Set it up so you can set up an investment account with your advisor where there's a draft from your checking account that goes in every other week. And whether you have commissions or not, you just make sure there's at least $200 in there, okay, whatever the number it is you're doing. Because if you'll do it as an auto pay and it comes out, you'll get used to that money not being there. If you wait until you have money, most of us that have had and own businesses, there's always a place to put money.
Yes.
I mean, there's no end to how much money you can spend on supporting your business.
For sure. Yep.
So it's
constant reinvesting.
Oh my goodness, it's so easy to let that go. When you put money in, I would encourage you to split it up 3 ways.
Okay.
So put some in an IRA. Why not? It's tax deductible. Put some into a Roth IRA. Then that way you're taxes, or you never pay taxes on those dollars, and put some into a what we call a non-qualified account, which is an account that's not an IRA. All right, you put it into all 3, because as you get closer to retirement, I'm going to tell you from experience, because of the tax consequences of how retirement money works, you want money in each bucket.
Yes.
And if you start out doing that, where that money is just automatically diverted, positions are purchased, your accounts grow, you will see, I mean, that will set you up really well for your future. But I have to say, you have to do it with an automatic bill pay.
Yes.
Yeah.
Right, because then you won't miss it, right? If you get into the habit and you're used to paying yourself first and just having it come out, then it runs the risk of, or otherwise you're looking at spending that money instead of paying yourself first.
It's too easy. It's too easy to do it. And you'll be responsible with your money if you have it set up that way.
Absolutely. So real quick, I know we're going to have to go to another commercial break, but where exactly is that money going when you're paying yourself first? Do you recommend putting it into just one mutual fund or several different mutual funds? How do you typically advise someone on how to invest that money?
So first of all, I'd have to say that when you sit down and talk to your advisor, this really does have to do with your time horizon. Truly, that is the thing. If you have time on your side, see, this is what happens when you get close to retirement. Your time horizon goes away. So now your investments need to change, okay? If you haven't done that yet, or if you've been letting it sit and it hasn't changed,
needs to change.
The strategy of the investments need to change. But when you're early on and you're beginning, or you're in the middle, say you have a 20-year time horizon before you retire, my recommendation is that you go after almost a more aggressive portfolio. Why wouldn't you? Give yourself a chance to grow more than 6%. Now, you also have to understand that $500,000 portfolio could drop to $400,000.
Right.
And if you can't stomach that, then you need to back off on how much risk you're taking. All risk is just the potential for the price of the assets that you own to fluctuate up or down. That's all risk is.
Yep.
And there's basically 3 types of investments. There's stocks, which is, you know, based on the company's profitability or whatever the technical analysis or is. And then you've got bonds, which has a yield. And then you have cash. Those are your 3 options.
Right.
That's all there is.
Yes.
Now, that could be a combination of mutual funds or ETFs. There's a lot of different ways to go about doing that. But you need some professional help with how to position those items correctly.
Right.
And the one thing I would say is, like, once a year is when you should go back in and kind of rebalance things out.
And make sure that the strategy is still applicable to where you are in your stage of life.
Exactly, because if you're in there messing with it, and excuse me for saying it like that, but if you're in there buying and selling and buying and selling, you're locking in losses, and you may not ever get to your destination.
Recoup that.
Exactly.
Absolutely.
Yeah.
Well, I think what you're speaking to is something that I know we've talked about on the show before, which is there's a difference between the accumulation phase, your working years when you're putting that money away, you're trying to grow and accumulate as much wealth as possible, and then as you shift in near retirement, there's the deaccumulation phase, and therefore your investment strategy needs to change. So here's the deal. This might be new to you, and you might be thinking, oh my gosh, I don't even know where to begin. The good news is it's not new to Cathy and the team at Theia Financial. This is what she does for folks day in and day out, and she would love to help you, another accomplished woman, as well. So here's what we're going to do. We're going to take another quick commercial break, but we encourage you, pick up the phone, call the number on the bottom of your screen, 866-724-4927, or scan that QR code to be able to schedule a time to meet with Cathy. It's just a simple 15-minute Zoom call for no cost, no charge, no obligation. Even if you're already working with another financial advisor, this is an opportunity for you to get a second opinion. And guess what? If you're currently working with someone and they're not having these kinds of important conversations with you, especially about how your investment strategy needs to change as you approach your near retirement, it's time to get that second opinion. So pick up the phone, make this important phone call, and when we come back, we're going to delve into some more important things that you need to be thinking about as it relates to your retirement. More after this.
We've all experienced those coulda, shoulda, woulda moments. When it comes to retirement, there are no do-overs. At Theia Financial, we understand the importance of retirement planning and turning your savings into reliable income you can count on. Retirement is more than just financial security. It's about spending quality time with your loved ones, embracing your creativity and pursuing your life's passions, and discovering the countless marvels that make our world a truly remarkable place. With a belief in the power of preparation, we work with accomplished women to design personalized plans. Don't leave retirement planning up to chance. Take control of your financial future and turn your retirement dreams into a long-lasting reality. Contact us today to schedule your free consultation.
Welcome back to The Accomplished Woman with Cathy Mendell. I'm your host, Kristin Oakley. And Cathy, we are having a very important discussion today about, we started off talking about this concept of market timing and why that is not the strategy that you want to employ with your hard-earned money, especially as you're approaching or nearing retirement. We've talked about how it's so important to pay yourself first. I know we have a lot of accomplished women who are watching who, gosh, are across the spectrum. Some are just early starting in their working careers. Some are approaching nearing retirement. What would you say to a woman who's watching who is afraid that maybe they did get started later in life with saving, maybe they're afraid that they don't have enough of a time horizon left before they want to retire? So how do you go about that if someone is coming to you and concerned about their time horizon and how things need to adjust and change?
Well, that's a pretty common feeling. I think all of us feel that we could have done a better job.
Coulda, shoulda, woulda, right?
Yes, absolutely. And what I would say is the first step is to sit down and really look at the dream of your retirement. When you want this to happen, this transition in life, what you've done so far,
right,
where you're at with everything, what your current situation is with employment. And then we have to crunch some numbers because what you really need is a target that says, okay, I'm close, and I need to work 2 more years and I'll be there. I mean, it can be that simple.
Yes.
If it's just an unknown, there's always the fear of I don't want to give up my paycheck, so I'm just going to keep working.
I'm going to have to work forever.
I don't want to keep working, but I feel like I have to keep. That unknown is not good.
Yep.
So when you get close to retirement, or when you start, even when you start thinking about it, this is when you want to sit down with us and have a conversation about how much income will I need? How much income can I get? What's my cost of living look like? And all of those pieces then go together in helping you formulate your plan. Once you have that plan, it's awesome because you know what you need to do.
Yes.
And there's an end date in mind. And it's just so freeing to do that.
It's clear. And then it takes the mystery out of it. It takes the fear and panic. I think a lot of times as women, we do this in other areas of our lives as well. We worry about all the what ifs, and that's more stressful than the actual reality, right? We come up with all sorts of scenarios and stories in our minds that might not necessarily be true in serving us.
And you know, there's something else to think about with all of this is that sometimes you have changes in your life where you change a job, as an example. That happened to me, or actually I chose to do that in my early 50s. And I knew about tools that were out there, and I had an option. I could take my 401k and move it into my new firm at my advisory firm, or I could move it into an IRA and make other choices. And I just wanted to say, I did make another choice. So what I did is in my early 50s, my husband and I, we each of us took $250,000 from our investments, and we purchased a lifetime income annuity. Now, we're not retiring anytime soon, but the fact is that had a long time to grow. Here's why I did that. Because when we retire, that'll give us $33,000 a year of income.
Wow.
Each of us. So that's $66,000 plus our Social Security. That's over $100,000. Now, I could have put that $250,000 into gold or crypto or apartments or I don't know.
Any number of things,
Any number of things. I could have put it in the market, but I wanted to set myself up so that I could take that weight off my shoulders so that down the road, we already knew what was going to happen.
Yes.
And I really believe that there's a lot of planning that can be done even if you are not close to retirement, but especially true when you have access to some of your funds. And if you've retired and then if you left a job and you moved your 401k to your new job, that money can be moved.
Yes.
Most people don't realize it. Well, I'm not 59 and a half, I can't do anything. You can with that money. So we have helped a lot of people in this space who are not ready to retire yet set themselves up so they take some of the pressure off of knowing that they're going to have an income and they've already got it working for them and it's a guaranteed source. And there's some accounts that there's some annuities I really like and some I don't.
Right.
But we chose well. And it's been really fun over the years just to have no pressure about future income.
Oh gosh. And you know what I love about that story too, Cathy, is you're giving the choice and the options. And I think a lot of times people leave money behind if they change jobs, for example. They think they don't have a choice, but you have limited investment options when you are able to roll that over into something that works for you. What a game changer.
Well, it is. And the fact is that a lot of people don't know what to do with that money. They just put it in the market and it still feels incomplete. They don't feel like they have a sense of direction about tomorrow.
Right.
And so I think anything you can do with your financial advisor is to, even if you're young, I mean, don't worry about it if you're young. Look ahead, have them help you look ahead to those years. Put a plan in place that you know will work.
Well, and I know you would love to help people do that.
I would.
So one last time, tell them how they can.
Yes. So we absolutely love helping you think through this process. Our company, Theia Financial, that's all we do. We are very engaged in helping the accomplished woman retire.
Wonderful. Cathy, thank you so much. Thank you so much for watching. We'll see you next week. We encourage you, call that number. See you next time.